Hello again. So I know I have not posted as consistently as I was hoping to, but that's because the world has ended almost like 10 different times this year. Holy cow. Oh my gosh. I don't know about you guys, but I'm so over 2020. Why did we bother ushering it in? Oh, anyways, we are not talking about any of that today. We're only strictly talking about the markets. And so let's get into it. Okay, so if you guys are not familiar with this graph, I think I introduced it first time to uh, you guys in the virus versus the stimulus video. So go check that out if you haven't looked at it yet. But it explains what I'm about to show you with this graph. Okay, so the V shape is, of course, what we'd like to see happen. This is when the market was introduced, or rather, the virus was introduced into the market, and it caused havoc, and it plummeted. We had it bottom out. Then we started coming up. We hit 23,000 on the Dow, but we just couldn't get past the 24,000 mark for some reason. We wouldn't go below 23,000, but we were just kind of stuck in this limbo for a while. I mean, for several weeks actually. But once we hit the 24,000 mark on the Dow, then we hit 25, 26, 27 very quickly. I mean, like boom, boom, boom. Within, I think, like week and a half to 2 weeks, we hit those new levels very quickly. So 24,000 was a psychological barrier for most investors. And I kid you not, we are seeing investor behavior in full swing right now. Oh my gosh, it is crazy how predictable investor behavior really is. And let me show you what I mean by that. Okay, so we have the markets. We have these up and down movements, right? Okay, so the market's going up, 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 and it hits a peak. Then it starts going down. We have a market correction for whatever reason, or we have a pandemic that decides to plummet the markets. So it starts going down, 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 and people are like, oh, I can deal with it, I can deal with it. And they're like, nope, I can't, and they get out. Okay? At this point, individual investors are panicking and they get out. Then, because everyone is panicking, selling out, it pushes the markets further down, and then it starts coming up, 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 and about right here, people end up, individual investors are like, hey, I want to make sure it's a solid rally before I put money in, because nobody wants to put money in and have it plummet immediately after. So everybody's waiting and waiting, like, oh, I want it to be a solid rally. And I kid you not, again, everyone has the same thought, like within weeks of each other. And so then everyone plummet or pours money in and then pushes the markets up. Okay. Well, now what you have is a loss, because you sold low and then bought higher over here. And if you keep repeating this pattern every time the markets have movements, you're going to end up losing money. This is why most individual investors lose money when they are, especially when they're trying to time the markets. And we'll go into that a little bit further as to why this occurs. But institutional investors, the reason that they make money is this. Okay, so they don't always hit it right, but they're pretty close. Okay, so the markets go up, up, up. They know when the markets are peaking that they need to be pulling money out, because the whole name of the game is to buy low and sell high. So when the markets are high, they sell out. Then they know the markets, when after the correction or during the correction, that this is going to happen, where individual investors are going to pull money out and push it down even further. So right about here, they don't always get it right at the peak or at the trough, but they get pretty close. And when the markets are down, then institutional investors are pouring money in. So then it goes up, up, up. So now what you've got is, because they sold out here and they bought down here, well, now what you've got is a big fat profit. So believe it or not, we actually see this happen every time the markets have a movement. And it's happening right now. So the reason why it's so hard for individual investors to really basically time the market, or to basically just not sell out or buy at the wrong time, is because they are emotionally connected with their money. Institutional investors, there's a degree of separation because it's not their money that they're using to trade, it's the company's money that they're using to trade. So they're able to look at it a little bit more objectively, because logic would dictate you would buy when the markets are low and sell out when the markets are high. But emotions go the opposite direction. They go exactly the opposite direction. They overload the system and put a whole bunch of fear in you, and you get so scared that you sell out when it's low, and then you buy back in when it's high, when everyone else is feeling optimistic. And so it's and I mean, rightfully so that you're emotionally connected to your money. I mean, it's your blood, sweat, tear money. Like, it's money you saved that you worked for. So naturally, you're going to be emotionally connected with it. And so, but it's the reason I bring that up, the investor behavior, is to help people be a little bit more aware of the fact that they do this. Because if you can think of, investing through a logical lens as opposed to an emotional lens, you're going to come out ahead. You're going to do better because your logic isn't being overridden by your emotions. So, but it's a very fascinating, trend to watch. Every time I see it, it's like, holy cow. It's just, again, it's predictable, but it's still amazing to see to me, just because humans, we are freaky, weird things. So we have some weird tendencies, and a lot of those trends, they don't change just because human nature. It really, I mean, it's very difficult to change human nature. Look at the history of time, and we really haven't changed much. I mean, technology has changed, and how we structure society has changed, but human nature itself, really, it genuinely hasn't changed since we've been keeping records. So it's really crazy to see this behavior, showing. Let me show you this behavior showing in the markets. It's fascinating. Anyways, okay, enough of that. So another point I wanted to touch up on is looking at the different indices. So a lot of people, they like to follow the Dow as a market indicator. I personally, so this is just kind of how I look at it. So a lot of people like to track the index, the Dow index, as the market indicator. I really use that more as like a psychological index of where investors are at. The S&P 500 for me personally is a much better gauger of the markets because it's so much more broad. It's literally got 500 stocks, hence the name S&P 500. It's got 500 stocks listed in that index, and so it's actually, to me, a better gauger of really what the markets itself are doing. Then, of course, there's the NASDAQ, which actually holds a lot more. I don't necessarily follow the NASDAQ as any indicator. I really prefer the S&P as my market indicator, and then the Dow as the kind of psychological indicator. And the reason I say that is because more often than not, the Dow is reported in the media, and a lot of people use that as the market indicator. And so they follow that and they react to data about the Dow. And it's really popular just because it's been around forever. S&P, the S&P 500 index has not been around anywhere near the level that the Dow has been around. But the reason I don't like the Dow as a market indicator, and it's more of a psychological indicator for me, is because it only holds 30 stocks. So I've told you guys this before in another video, but it's still a really good analogy, so I like to use it. Well, it's not an analogy, I guess. It's just facts of how the Dow works. So the reason I say it's not a really good indicator, because it's got only 30 stocks, is if one of those stocks within the Dow move largely in a day, then it influences the whole index. So example, Boeing. I've used this example before. Again, it's still relevant, still a good example. When the markets are all moving and Dow was having, or the Boeing stock was having its issue with the 737 MAX, it kept plummeting. And the rest of the stock market was actually going up, but the Dow or the Boeing stock was plummeting, and it affected the Dow index. And so you'll see variations from the Dow, the S&P, and NASDAQ, where sometimes the Dow is up and S&P is down, or vice versa, or whatever. Sometimes, I mean, a lot of times they really do move in tandem, but you do see sometimes where they will be opposite of each other, and that's because there's some sort of investment in the Dow that is causing it to move in the opposite direction of all other stocks. And then the NASDAQ, it was the kind of preferred index for the tech companies when they would have their IPOs. And so a lot of, and that was like from the 90s, and it's still very highly favored. So a lot of the tech companies are listed on the NASDAQ. And so when the tech sector has big movements, it will affect the NASDAQ differently than it will affect the other two indices as well. So you're going to see variations of all three. This is why you see variations of all three. Why you'll see, maybe the NASDAQ is down, but S&P and Dow are up. Or you'll see the S&P down and Dow and NASDAQ up. Or, you'll see different combinations, or rather, I guess, permutations. And so, but that's why you're going to see those types of differences between the different indices. And so again, the NASDAQ, I don't necessarily, pay too much attention to. Not that it's not important. It's just, I feel like everything I need is covered by the Dow and the S&P 500 index. And so I just follow those more closely than I do the NASDAQ. But there you go. I told you it'd be a quick video, and we're not going to talk about anything else other than just the markets. The economy, I feel like we are going to see the full effects of unemployment later down the road. I think that the unemployment numbers that we have been reporting, the effects of that really have not been fully felt, and largely in part due to the fact that there's still some places that have lockdown restrictions, and another factor being that the stimulus package that was passed and everyone given free money, that's, I'm going to say, in the next few months, we're going to see the full effects of unemployment being hampered by the stimulus package and the lockdowns, which is unfortunate because that is right in the middle of election season, and election season is always crazy anyway. We don't need it to be more crazy, but I would not be surprised if that's what we see. We're just not seeing the full effect of the unemployment yet, and I think that it's going to rear its ugly head later on. And I can't say I'm too confident in the stability of the U.S. economy right now. The Federal Reserve fired their magic bullet by reducing the rates really low. I felt that they reduced it too quickly and way too low. But it is helping to cause a lot of refinancing and home buying right now. But that's going to be, I think we're going to see a slowdown in that once the unemployment, the full effect of the unemployment numbers rear its ugly head. So we're still more stable than other economies, but I think that the pain is yet to come. So hopefully I'm wrong. Hopefully I am wrong, but I think we're gonna see that later down the road. So brace yourself for that if it comes. So I gave you fair warning. Anyways, so there's that. If you guys have any questions, as always, put them in the comments section below. Hit that subscribe button, and I will talk with you guys later.